In the fall of 2024, the Federal Reserve cut the Fed funds rate by a full 100 basis points. Conventional wisdom suggests that lower short-term rates should drag down longer-term yields, but that's not what happened. The 10-year Treasury yield actually rose, going from 3.6% up to 4.7% over the same period. Analysts were quick to call the rate cuts premature, arguing that inflation hadn't been fully defeated and that the Fed was risking another wave by easing policy too soon. 10 months on, the bond market's skepticism looks justified, as headline inflation is still well above the Fed's 2% target. Now fast forward to this September, as the Fed has restarted its rate cutting cycle at the September 17th meeting. The cut reignited questions about how the 10-year yield will react. So far, things have been remarkably smooth. Just before the cut, the 10-year was trading at 4.05%, and over the next 5 days, rallied slightly to 4.13%. So is this a signal of renewed inflation concerns? Most analysts would say probably not, and that the modest jump in yields suggests a move was more about market rotation into equities that could benefit from lower borrowing costs. Of course, the bond market's opinion regarding inflation could change at any moment as we see more PCE and CPI data in the coming months. Now, the most difficult thing will be an attempt to ascertain if the rise in yields is due to inflation concerns or other reasons, like the growing pile of debt that needs to be rolled over without the appetite from China that has benefited the U.S. for decades.